Most people want a better life. They imagine more freedom. They dream of more security. They wish for less financial worry. Yet, only a small fraction of people ever build significant wealth. Around 95% of the population remains financially average. This outcome is not usually a matter of luck. It is not a question of intelligence. It is not a question of raw talent. Instead, it is a story of thinking. It is a story of habits. The script most people follow is written by psychology, not by spreadsheets. It is a quiet, powerful force that guides decisions day after day, year after year, leading almost everyone to the same place. It is not one lucky stock pick. It is not one brilliant invention that appears from nowhere. It is the slow accumulation of thousands of tiny, almost invisible choices. These choices are driven by deep-seated beliefs about money. They are driven by beliefs about risk. They are driven by beliefs about success. They are shaped by the stories we tell ourselves about who we are and what we are capable of. Most people follow a well-trodden path because it feels safe. It feels familiar. It feels normal. They operate on a default setting, unaware that another way of thinking even exists. This is the power of the broke script. This is not a judgment. It is an observation. The script that keeps people average is not malicious. It is a protective mechanism, born from a desire for stability. It is born from a fear of loss. It whispers that it is better to have a little for sure than to risk it for a lot. It suggests that fitting in is more important than standing out. It teaches that work is about trading your time for a paycheck, and that is the end of the transaction. These ideas are not wrong in the short term. They provide comfort. They create a predictable existence. But over a lifetime, this way of thinking builds a cage, not a kingdom. The path to wealth, then, is not about finding a secret map. It is about rewriting the internal script. It begins with the simple, yet profound, realization. Your financial destiny is primarily a product of your own psychology. It is about understanding the mental models that keep you stuck. It is about consciously choosing to adopt new ones. The journey is not about becoming a different person overnight. It is about making slightly better decisions, consistently, over a very long time. The game is won in the mind before it is ever won in the bank account. This is the first and most important lesson. The human mind is wired for safety. It craves predictability. It seeks the path of least resistance. This is the foundation of the comfort mindset, the single most powerful force keeping people financially average. A steady job with a regular paycheck feels secure. A familiar routine removes the stress of uncertainty. These things are not inherently bad. They provide a foundation for life. But when comfort becomes the ultimate goal, it quietly suffocates ambition and discourages any journey into the unknown. True growth rarely happens inside the comfort zone. It happens just beyond its edge. People who prioritize comfort above all else learn to see risk as an enemy. The possibility of failure, of losing money, of looking foolish, feels like a physical threat. Their brain interprets this potential for loss as something to be avoided at all costs. As a result, they turn down opportunities that carry uncertainty, even if those same opportunities hold the potential for massive rewards. They choose the small, guaranteed win over the large, uncertain one. They might take a small annual raise but would never consider starting a small side business. The fear of what could go wrong paralyzes them from ever discovering what could go right. This preference for safety is a long game with compounding consequences. A single decision to choose comfort over risk is insignificant. But when that same decision is made hundreds of times over a decade, the impact is enormous. The person who always stays in their safe job never learns the skills that come from building something from scratch. The person who never invests because the market feels volatile misses out on decades of potential compound growth. The comfort mindset creates a life that is stable but flat. It is a life lived on a plateau, where the peaks of great success are never reached because the valleys of potential failure are too frightening to cross. Wealth, almost by definition, requires a different relationship with risk. It requires seeing risk not as a threat to be eliminated, but as a price to be paid for a chance at a greater return. It means stepping into the unknown. It means being willing to be uncomfortable for a period of time in pursuit of a long-term goal. Breaking free from the gravitational pull of comfort is the first act of defiance against the average script. It is the conscious decision to accept that a little bit of controlled chaos is necessary for creating something far greater than a predictable, steady existence. For most people, the concept of earning money is simple. You work for an hour, you get paid for an hour. This is the salary mindset. It is the idea that your income is directly tied to the time you put in. Society is built on this model. We are taught to get a good education, to get a good job. We are encouraged to climb the corporate ladder, seeking promotions and raises. This path is logical, clear, and provides a sense of progress. A higher salary feels like success. It allows for a better lifestyle, a bigger house, a newer car. But it is a fundamentally limited way of thinking about wealth. The salary mindset has a built-in cap. There are only so many hours in a day. There are only so many years in a career. By trading time for money, you are trading a finite resource. You can become a highly paid professional, a doctor, a lawyer, an engineer, and make a very good living. But you are still on a treadmill. If you stop working, the money stops coming in. This creates a constant, low-level anxiety. You are dependent on your ability to show up and perform. Wealth, in its truest sense, is not about having a high income. It is about decoupling your income from your time. The alternative is the wealth mindset. This way of thinking is not focused on earning, but on owning. People with a wealth mindset understand that true financial freedom comes from assets. Assets are things that generate money even when you are not actively working. Businesses that run on systems, real estate that produces rental income, stocks and bonds that generate dividends and capital gains. The goal is not just to make money, but to acquire things that make money for you. This shifts the entire equation. Instead of trading your limited time, you are using your money to build an army of workers that never sleep. This is a difficult mental shift to make. The salary mindset is comfortable because it is tangible and immediate. You work, you get paid. The reward is clear and quick. Building or buying assets, on the other hand, is slow, uncertain, and often boring. It requires delaying gratification. It means taking money you could spend today on a vacation or a new gadget and putting it into something that might not pay off for years. It is a quiet, unglamorous process. This is why so few people do it. The siren song of immediate reward is far more seductive than the quiet promise of future freedom. We do not form our ideas about money in a vacuum. We are social creatures, deeply influenced by the world around us. From a young age, we absorb messages from our family, our friends, our culture. These messages form a powerful social script, often invisible, about how we should behave with money. For most people, that script is focused on spending. We are bombarded with advertisements promising happiness through purchases. Social feeds show a curated highlight reel. Exotic trips, luxury goods, expensive experiences. Status is demonstrated through spending. This pressure creates lifestyle inflation. As income increases, spending rises to meet it, and often exceeds it. A raise doesn't raise your savings rate. It leads to a more expensive car payment, a bigger mortgage, a more lavish vacation. People feel intense pressure to keep up with peers. In the modern world, that instinct is exploited, keeping us on a treadmill of earning and spending. The result: very good at looking rich, very bad at becoming rich. Wealth is the money you do not spend. Wealth is the assets working quietly in the background. Wealth is unseen. A fancy car is not wealth. It's a visible slice that's been spent and can't grow. Society rewards the visible. No one applauds a large brokerage account. people admire your expensive watch. This feedback loop destroys wealth and punishes wealth-building habits. To break free, become a conscious objector to the social game. Choose success on your own terms, not by your neighbors or your Instagram. Find satisfaction in invisible net worth growth, not fleeting purchases. It's difficult. It can feel isolating. It means saying no when the world screams yes. It's a necessary rebellion. You can't follow the herd and expect a different destination. Building wealth requires being a little bit strange. Beyond social pressure, the most powerful force shaping your financial life is your own identity. We all have a story we tell ourselves about who we are. This story includes our beliefs about money. For many, that story is filled with limiting beliefs. I'm just not good with money. People like me don't get rich. Money is the root of all evil. These are not just passing thoughts. They are core components of a person's identity. And we will all fight tooth and nail to act in a way that is consistent with our identity. Our inner compass always points back to who we believe we are. If you believe you are someone who is bad with money, you will subconsciously find ways to prove that belief true. You will make impulsive purchases. You will fail to save. You will ignore your bills. When things go wrong, you will say to yourself, "See, I told you I was bad with money." This creates a self-fulfilling prophecy. Your actions reinforce your identity, and your identity guides your actions. This cycle is incredibly difficult to break because challenging the belief feels like challenging your very self. It is easier to stay broke and be right about your identity than to become wealthy and be wrong. These beliefs are often formed in childhood, absorbed from the attitudes and behaviors of our parents. If you grew up in a household where money was a constant source of stress and arguments, you might develop a belief that money is inherently negative and something to be avoided. If you were told that rich people are greedy or unethical, you will subconsciously sabotage your own success to avoid becoming one of them. These early money scripts run in the background of our adult lives, quietly directing our choices without our conscious awareness. They are the ghosts of the past, haunting our financial present. Therefore, the most profound work in changing your financial future is not learning about stock market analysis. It is about excavating and rewriting these deep-seated identity beliefs. It starts with awareness. You must listen to the stories you tell yourself about money and question them. Is it really true that you are bad with money, or have you just been practicing bad habits? The next step is to consciously create a new identity. Start telling yourself, "I am a person who saves. I am a person who makes smart financial decisions." At first, it will feel like a lie. But if you align your actions with this new identity, no matter how small, the belief will slowly begin to change. Action precedes belief. If you observe the habits of people who successfully build and maintain wealth, you will find it is not magic. It is a pattern. They consistently follow a blueprint of behaviors that is often the mirror opposite of the average person. The first and most critical behavior is long-term thinking. They do not make financial decisions based on what they want today or this month. They make decisions based on where they want to be in 10 years, 20 years, 30 years. This long-time horizon changes everything. It makes saving more important than spending. It makes enduring market downturns possible. It turns patience from a virtue into a strategy. A second core behavior is the mastery of delayed gratification. Society screams for immediate rewards. The wealthy learn to ignore that scream. They understand that every dollar not spent today on a fleeting pleasure is a dollar that can be invested to work for their future. They are willing to live below their means, not because they are cheap, but because they value future freedom more than present status. This is a quiet, disciplined act. Third, they embrace calculated risk. While the average person fears risk and seeks comfort, the wealthy understand that risk is the price of admission for superior returns. They are not reckless gamblers. They are careful assessors of probability. They take risks where the potential upside is significantly larger than the potential downside. They start businesses. They invest in equities. They purchase real estate. They know they might lose money on some ventures. But they also know that over the long term, a portfolio of calculated risks is the most reliable path to significant growth. They are comfortable with uncertainty because they have a plan. Finally, they behave with emotional discipline. The financial world is driven by fear and greed. Markets crash, and fear tells you to sell everything. A new trend emerges, and greed tells you to pile in. The wealthy learn to insulate their decisions from these powerful emotions. They build systems, like automatic investing and diversification, that allow them to stick to their long-term plan regardless of the daily noise. They do not react to headlines. They act on their strategy. This consistency is their superpower. It is the steady, relentless application of good habits over decades that ultimately builds the edifice of wealth. That consistent application is really what matters. The principles of wealth psychology are not just theory, they are visible in the stories of real people. Consider Bill Gates. In the 1970s, the safe and predictable path was to finish his education at Harvard and get a prestigious job. That was the comfort zone. Instead, he made a decision that looked insane to many. He dropped out to start a fledgling software company called Microsoft. This was a monumental act of embracing risk and long-term thinking. He was not focused on a steady paycheck. He was focused on ownership. He chose to build an asset, and that single decision to defy the conventional script made all the difference. But you do not need to be a famous tech billionaire to see these principles in action. Think of the quiet investor, the person no one knows is wealthy. This could be a teacher, a plumber, a secretary. They earn a modest salary, but they have a different mindset. From their very first paycheck, they decide to save and invest a portion of their income, no matter how small. They live in a modest house and drive a reliable used car. Their friends and neighbors, who earn similar incomes, spend everything on new cars and lavish vacations. The quiet investor ignores the social pressure. They are playing a different game. Over decades, the power of this behavior becomes undeniable. The quiet investor's small, consistent contributions to their investment account begin to compound. The money starts to make more money. After 30 or 40 years, their net worth has grown to a surprising size, often surpassing that of their higher-earning, higher-spending peers. They did not win the lottery. They did not inherit a fortune. They simply applied the blueprint. They thought long-term, they delayed gratification, they controlled their spending, and they let their assets do the work. Their wealth was not built by a high income, but by a high savings rate and the patient passage of time. These examples, from the world-famous entrepreneur to the unknown millionaire next door, reveal the same underlying truth. The specific vehicle for wealth may change, business, stocks, real estate, but the psychological engine is always the same. It is a mindset that prioritizes ownership over income, long-term freedom over short-term status, and disciplined behavior over emotional reaction. They did not stumble into wealth. They built it, brick by brick, with every decision that went against the grain of average thinking. They chose to write their own script. If the path to wealth is so simple, why do so few people follow it? The answer lies in the architecture of our own brains. The human brain evolved in an environment of immediate scarcity and danger. It is not naturally designed for the modern world of long-term investing. Our brains operate on a default setting that prioritizes short-term survival, immediate reward. This ancient wiring makes the behaviors required for building wealth feel unnatural and difficult. Resisting these defaults requires conscious, sustained effort. It is a battle against our own biology. Preference for comfort, fear of risk. For our ancestors, a strange rustle in the bushes could mean a predator. The safe bet was always to retreat to the familiar cave. Our brains are still wired with this better safe than sorry algorithm. The stock market's volatility feels like that rustle in the bushes. The brain's immediate emotional response is to flee, to sell investments and seek the safety of cash. It takes a logical, disciplined mind to override that primal fear and stay invested for the long term. Comfort feels good because it signals safety to our ancient brain. Our brains are hardwired for instant gratification. When our ancestors found a berry bush, the right strategy was to eat as much as possible, right now. There was no guarantee the berries would be there tomorrow. This created a powerful reward circuit in the brain that releases dopamine in response to immediate rewards. This is why spending money today on a new phone feels so much better than saving it. The new phone is the berry bush. The investment account that grows slowly over 40 years offers no immediate dopamine hit. Delaying gratification is a direct fight against this primitive reward system. Social conditioning adds another layer. As social animals, our survival once depended on fitting in with the tribe. Being ostracized could mean death. This has left us with a deep-seated need for social approval. We constantly scan our environment and copy the behavior of others to ensure we belong. When everyone around us is spending money to signal status, our brain tells us we must do the same. Saving and investing, being frugal, being different, can trigger a primal fear of social rejection. Understanding these psychological forces is crucial. They are not excuses, but they explain why the broke script is so powerful and so common. Understanding the psychology is the first step. The second is action. Breaking the broke script is not a single event. It is a process of replacing old habits with new ones. Start small. The goal is not to change everything overnight, but to build momentum. The first practical step is to automate your savings. Set up an automatic transfer from your checking account to a savings or investment account the day you get paid. This puts your most important financial decision on autopilot, bypassing the need for willpower. Pay yourself first before you have a chance to spend the money elsewhere. Next, you must actively change your identity. Begin to tell yourself a new story. Instead of "I'm bad with money," start with "I am a person who is learning to be good with money." Reinforce this new identity with small, concrete actions. Read one article about investing. Track your spending for 1 week. Open a brokerage account. Each action, no matter how minor, serves as a vote for your new identity. Over time, as the evidence builds, your belief in this new identity will solidify. You become what you repeatedly do. Your identity will eventually follow your behavior. You must also curate your environment. You are the average of the people and information you surround yourself with. Unfollow social media accounts that exist only to promote lavish consumption. Instead, follow voices that discuss personal finance, investing, and long-term thinking. Read books on the psychology of money and the habits of the wealthy. Talk to friends or family members who have a healthy relationship with their finances. By changing your information diet, you slowly retrain your brain to see new behaviors as normal. You are creating a new social script for yourself. Finally, embrace the long, slow, boring path. Wealth is not a get-rich-quick scheme. It is a get-rich-slow process. There will be times when it feels like you are making no progress. There will be market downturns that test your resolve. During these times, you must trust the process. Focus on the consistency of your habits, saving, investing, learning, not on the short-term results. The greatest returns do not come from being the smartest investor, but from being the one who can stick with a reasonable plan for the longest period of time. The script can be broken. The story can be rewritten. Understanding the psychology behind money and behavior is the first step to unlocking wealth. Start that step today. Go on. Start now.